question that is very interesting for a lot of founders and fund managers. How should they approach family offices?
It's very interesting. I had a conversation. I had a conversation with someone yesterday. Actually, I won't mention the name of the fund, but I just made the point that typically with the family office, like because they were dealing with such a personal, two sides. Because you're doing the personal side, like this is someone's family legacy. It's their family wealth, and it's not institutional in nature. There's a different approach that's needed in consideration of that. And then secondly, it's also just a difference in perspective completely. If we think about a private equity fund or a VC fund, like typically your timeline is 5 to 10 years, right? And this is a well-known fact that family offices and families have a very different time horizon, and they're willing to take, some of them are more risky, some of them not, but all of them are willing to tolerate a much longer investment horizon with an understanding that value is going to come towards the end of that. And I think if you go in with understanding of both of those, then it changes the conversation quite a lot. And I think one of the most important things is that you have to relate to the person and understand that the first conversation you have with the family office is obviously not going to be the one where you sign a check, maybe not even the fourth or the fifth. Like the whole point of this long-term perspective plus personal relationship is that you actually have to build the relationship. And once you build the relationship where you see an alignment as a family office on values and you like the people that you're working with, and then you can say, actually, I want to invest with this person and maybe we want to end up investing for the next 25 to 35 years together. And that is then when you've got your hook with that understanding in mind.
So how many meetings, how many years do you need to build relationship usually?
I think that depends on the person.
Yeah,
definitely.
I agree, yes. I agree that sometimes you have to become friends with the family members, like know their children and everything. So this type of relationship,
Yeah, I would say from our perspective, because we've been around for a bit and because we have a decent sized team, people know about us, and we get probably on a weekly basis, unsolicited, we probably get at least 30, 40 invites to conferences per week.
Well, thank you for coming.
So
I feel privileged now.
I know. It's honestly, well, you did something very nice. I live just around the corner, and my office is up in St. James's, so this couldn't be better. Perfect timing. 10 o'clock. Nice chat with wonderful people. Absolutely delightful to be here with you all. So this is absolutely perfect. Spot on. So well done. But yeah, something like that's just conferences and events and dinners and what have you. And then funds, even more than that, on a weekly basis. So obviously you've got to put a system in place, because otherwise how can you even politely come back and say no? So what we have done is actually we've chosen to be very transparent. So we've actually put everything out on our website, where there's the process, how to approach us, what we're looking for, what we're not looking for.
Oh wow.
So if people can read, then there's a great chance that they will lose or waste less of their time, and will waste less of our time. Because we've been so transparent and putting it out there. I mean, you'll still be amazed how many people can't read, but at least you can refer back to that, and here's the process. Yeah. What we tend to do on the fund side, for instance, is that, I mean, we look at track record. That's a key thing for us, and we are quite quantitatively driven. So perhaps unlike the previous comment, we're quite quantitatively driven at first, meaning we look at past performance. We got to look at something. And if we had this conversation 5 years ago, and we had invested, what would that have done? Of course, past performance is no indicator of future performance. We know that. But you got to start with something. And if somebody is hitting the high notes of fund performance over the past, say, 5 years or even longer, and bearing in mind, high notes would also mean, for instance, if it was a liquid fund that did plus 5% in 2018, that's a good number. Plus 5% is a good number in 2018 if you're hitting high notes in the other years. i.e. if you can manage the drawdowns when life is a bit sort of challenging, for 2022 for instance, where a lot of the long positions obviously were suffering. What we do to counter that is we put an overlay of CTAs on top, and that helps our portfolio a lot. So our portfolio of CTAs was up between 25 and 35% in 2022, and that is the year where you need help the most to manage the drawdowns, because your bonds are down, your stocks are down, and your real estate probably also takes a little bit of a beating. So CTAs is a quite good thing to have in the mix to cushion when life goes south.
So how long, in general, I know it depends, but in general, how long does it take to onboard a fund and onboard a director?
So what we do is we do our research through fund managers. We look at their performance, and if they are indeed good, we go through the DDQ, the interviews, etc. And then let's say somebody makes it through those various needle eyes. We put a given fund on the bench, if I can use football analogy, put them on the bench, so they're sitting there, ready to be put into the pitch. If one of the other players gets tired, a little bit tired, that happens, then you take that player off, and then you have your plan B or your bench players, and then you can put them straight in. So that's how we do it, and then we will typically go in small, and then if they keep playing well, we'll increase the exposures. So that's how we go about it.
Great analogy.
On the family office side, I don't kind of go in with, here's this fund. It's more, you listen what they're trying to solve for, and then you can be creative about what could fit. And sometimes it's nothing to do with KKR. Like sometimes I'm like, you know what, you should actually speak to this family office because they're doing something quite similar to you. And that's a successful meeting. So work with families operating businesses, so we can help with the debt and equity financing of their operating businesses. We can buy businesses from families, sell businesses to families, and they can of course invest in our funds, co-invest and sell to deals. So I think when people understand that more, it's a bit of a different discussion. But
I think there's it's my understanding that there is a little bit of also geographical difference to answer that question between say the US and Europe. I think in the US you see deals, certainly direct deals being done like there's no tomorrow. Hey, it's this thing and it's cool and it's hot and it's whatever, and who cares about the valuation? But anyway, here, collaborate with some US family offices. Some of them can be a lot more transactional and certainly quicker, but I don't know if you've experienced that. But you certainly see there's a US-European divide, and I don't know which one is best, but there certainly is a difference there.
Yes, it is. I can tell in Kazakhstan, and I know in Middle East as well, you have to have dinners and dinners and lunches. Yes.
Yeah, certainly in the Middle East as well.
Yeah.
We're quite closely connected to the UAE in many ways at government levels, and also we have some fantastic relationship with family offices there. And the big mistake some of the US asset managers do is they fly into Abu Dhabi, spend 2 days there and hard pitch, and then they're off the plane again and nothing happens. It's not how it's done there. It's relationship, it's time, it's get to know each other, it's very softy, and then suddenly, by the way, and it sort of comes up that way. It's a lot more relationship driven.